Just in 1 day and a half, one of the largest banks in the United States collapsed in what is now known as the second biggest bank failure in the country's history.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
This really is an earthquake, especially for the tech community. Silicon Valley Bank dropped by 60% yesterday alone.
A member of gigantic banking players, not only in the US, but also in the entire world. Silicon Valley Bank's unexpected fall instigated many other bank closures, shook global markets, and threatened the sustainability of startups in the US and almost everywhere else. So the impact of the bank's collapse was felt almost everywhere, but this time around, all eyes on California, United States. Almost immediately, everything seems to be easing. Stock markets are already in positive territory, and currency markets have calmed down. Despite all this, another bank has fallen a few days after the Silicon Valley Bank's collapse. But with banks collapsing, what happens to your money? Do you ever ask yourself this question? What are the banks doing with the money that we deposit? And whatever that is they do with our money, is our money safe? Let's answer all these questions as we look into Silicon Valley Bank's rise and fall when a singer unfolds. Silicon Valley Bank derived its name from a region on the San Francisco Peninsula in California, where the small-scale electronics industry is centered. It is so called since most of the devices built in this place are made of semiconductors such as silicon. When a booming electronics industry emerged in the 1960s and inspired the name Silicon Valley after the main element in integrated circuits. In the 1970s and 80s, this cluster of South San Francisco cities would rupture and even invent the very first computer. Amidst exponential growth and competition, new companies would find it extremely difficult, from raising money to start up, all the way to maintenance. While this was happening, banks were so skeptical about tech ventures and therefore made it almost impossible for such businesses to acquire loans. But one day over a game of poker, two former Bank of America managers, Bill Biggerstaff and Robert Medeiros, conceived an idea to form up a bank that would provide banking services to startups in the Silicon Valley region. Later, these two experienced people started the Silicon Valley Bank with a focus on helping fledgling tech companies and would set up their office in San Jose, California. The two went on to hire Roger V. Smith, who had previously headed a high-tech lending unit at an American multinational services company called Wells Fargo, to be their bank's first president and CEO. With almost everything set, the bank launched on October 17, 1983, as a wholly owned subsidiary of SVB Financial Group, a financial services holding company that was then called Silicon Valley Bank Shares, with only 100 investors. Silicon Valley Bank would start its works, and surprisingly, it started growing. The fact that SVB allocated its services to a new like space of customers, the institution's growth would come quicker. At the time of forming Silicon Valley Bank, the then banking industry did not have a good understanding of startup companies. Young companies that are founded to develop unique products and services, but also bring such products to markets and make them irresistible and irreplaceable for customers. In our days, think of something like creating an online grocery store service, developing a dropshipping business, starting a podcast, and developing a blog. SVB did not join other banks in ignoring juvenile companies that particularly lacked revenue. The bank, however, structured its loans with the understanding that startup businesses do not earn revenue immediately, and so being able to manage risk based on their business model. In the United States, nearly half of the country's venture capital-backed technology and life science companies would take advantage of SVB services while relying heavily on this bank. The bank continued connecting customers to its extensive venture capital, law, and accounting framework. In the following years, SVB fronted the collection of deposits from businesses financed through venture capital as its main strategy, and after setting up a dominant effect, SVB expanded into banking and even financed venture capitalists as one of the ways to add more services that would allow the bank to keep developing customers as they matured from startup phases. In doing this, however, SVB set up strict measures to avoid risks that would have collapsed the bank immediately. Loans would not be acquired with extreme ease. Even startup founders had to pledge about half of their shares as collateral in need of a loan. But rates would later fall, reflecting a low failure rate and founders' tendency to pay off these loans and so to remain in control of this company. But in cases where debtors failed to pay off their loans, SVB would automatically alternate to selling their collateral shares to any interested investors. It also became common for venture capital companies' term sheets, which are non-binding agreements that shows the basic terms and conditions of an investment, to require startups to include proof of owning an account at SVB. And lastly, the bank made startups that received funding from top-tier venture capital firms its priority as a way to reduce risk. Top-tier venture capital firms included Sequoia Capital, that specializes in seed stage, early stage and growth stage investments within private companies across tech sectors. New Enterprise Associates, which focuses investment stages ranging from seed through growth stages across an array of industry sectors. And Kleiner Perkins Caufield and Byers, which specializes in incubation investment, including early to growth stage companies. Silicon Valley Bank continued to grow alongside the high-tech economy, achieving more than 20 consecutive quarters of profitability. SVB went from a loss of almost $40,000 in 1985 to a profit of more than $12 million in 1991 after acquiring National Integrity Bank of Santa Clara in California and opening its first office in the East Coast during 1990 with the purpose of taking over the Massachusetts Route 128, which is a tech corridor. Under Smith's leadership, SVB diversified into the high-risk real estate loan business, which amounted to nearly half of its portfolio by the early 1990s. Because of this move, SVB made its second loss due to a slump in the California real estate market that saw the bank lose over $2 million during 1992, and by 1995, the portfolio percentage had fallen to only 10%. This catastrophe also shook up things within the bank. In 1993, Smith became the vice chairman, and John C. Dean would replace him as the new CEO. But this was not the beginning of the Silicon Valley Bank collapse as we know it today. Actually, it was re-strategizing for expansion. The bank added a winery lending business in 1994, actively participating in the wave of computer technology startups during the late 1990s stock market bubble, dubbed the dot-com bubble, adding branches in tech hubs and diversifying into a broader commercial bank, and so much more. The question now is, where did things go wrong? From the many reasons that could have been responsible for SVB's sudden fall, these are the key factors. Throughout the years, Silicon Valley Bank has been meeting and dealing with trying challenges, but nothing ever pushed this bank to its failure. In 2022, SVB began to incur steep losses following interest rates and a major downturn in growth in the tech industry, where the bank's liabilities were heavily concentrated. Some years ago, companies like Roblox, Roku, and many others that had put millions into the bank would also seem risky. These are companies that move quickly with their money, and when things went off the rails, they were also quick to move their money out of the bank. After the banking crisis that triggered the Great Recession, President Barack Obama would sign the Dodd-Frank Act that made banks such as SVB face stricter regulations as a way to make sure that banks in America follow the same set of rules and avoid disasters. But at that time, SVB said it was too small to need such regulations, and good for them. 8 years later, most of these regulations on smaller banks were rolled back by the Trump administration, and in the next 2 years, SVB was flooded with cash as businesses deposited more money during the pandemic. Deposits tripling to almost $190 billion, making 2021 SVB's most profitable year ever. With all that cash sitting in a bank, SVB decided to put it to some use, and so the bank bought tens of billions of dollars of longer-term US treasuries and government-backed mortgage securities. SVB's portfolio went up to almost $100 billion in just 2 months, but suddenly, rates started going down, and as this downward trend continued, SVB was sitting on a bunch of losses. As of December 31st, 2022, Silicon Valley Bank fair value accounting failed to realize losses in excess of up to $15 billion in securities that were held to mature. In early 2023, a combination of factors including poor management skills and the bank being driven by the inconstant tech industry all caused SVB to collapse. In the following events, news of the bank's collapse would circulate further. More customers would rush to the nearest branches to withdraw more than $42 billion that they collectively deposited. In this rush, SVB's stock price went into free fall following excessive withdrawals, running the bank out of cash. As the news of the bank's disaster continued surfacing on several social media platforms, early in the morning of March 10th, examiners from the Federal Reserve and the Federal Deposit Insurance Corporation (FDIC) arrived at the offices of SVB to assess the company's finances. A few hours later, the California Department of Financial Protection and Innovation (DFPI) issued an order taking possession of SVB, citing inadequate liquidity and insolvency. The California Department then appointed FDIC as the receiver. In a follow-up statement later, the FDIC said that customers would have full access to their insured deposits in just 3 days. Regulatory filings from December 2022 estimated that more than 85% of the deposits were uninsured. That is more than $151 billion in deposits. This would mean that clients will not get any amount in excess of $250,000 limit each had in their accounts. On March 13th, the FDIC announced having transferred SVB assets to a new bridge bank, an institution created by a national regulator or central bank to operate a failed bank until when a buyer is available. The failure of SVB was the largest of any bank since the 2007-2008 financial crisis by assets, and the second largest in the United States history, behind that of Washington Mutual. But after only 2 days from SVB's collapse, another bank with a different set of problems known as Signature Bank failed, and it was also seized by regulators. So, the third largest failure in history. In both disasters, however, regulators would later announce that even uninsured deposits over $250,000 would be covered, but it's only good news for the SVB's clients and not shareholders. As investigations into SVB continue, President Biden promised to ask Congress and the banking regulators to strengthen the rules for banks so to make it less likely for such failures to ever happen again. But will this work? For now, you can only wait and see. Thank you for watching this US banking disaster. I will see you again soon.